inflation, the banking crisis, possible recession. But some people, we're going to call them contrarians for this conversation, say that could also lead to a rally. So where are you at? Contrarian, consensus? What's your S&P price target? What's your outlook?
We're definitely contrarian. Since the beginning of the year, we established a 4,500 price target for the S&P. That's 19 times 2024 earnings. And what we do think is going to be true is when we hit July, investors will start to be focused on 24. And even more importantly, the inflation data, mostly because of arithmetic, we're forecasting that CPI headline goes to 3.5 and PPI to only 0.9, and that's important because it's leading. And that's not a heroic estimate on our part. It's just that we're rolling off 2 months of over 1% per month last year. So we think even the Federal Reserve will start to recognize that inflation's declining, and that'll set us up for a summer rally.
All right, so you're saying a summer rally. I want to be clear. You said your S&P outlook's 4,500?
Correct, yes.
All right, so about an 8% upside from here. I also want to talk
I'd say there's more risk to the upside at this point, because of AI and a potential tech boom.
Yeah, I mean, AI is going to obviously potentially have a big influence on a lot of things, potentially deflationary. Maybe that speaks to your PPI estimate as well. But I do want to switch gears just for a bit. When it comes to bonds, you're watching the bond market, and you believe that the $52 trillion in assets that global pension funds are holding, that's going to be a big influence to the bond market. Explain the theory and why that, which is a pretty stable set of assets, is going to have a big influence on the bond market.
Yeah, definitely. And a lot of investors don't recognize that 32 trillion of that is actually in the United States. Most of our pension funds are quite well funded. We always focus on the ones that aren't, like in Illinois, but most of them are well funded. And they're also under allocated to bonds. They're only 28% allocated to bonds. That's all bonds. So if treasuries rise like they have, they start to become pretty close, or at least a good percentage of the benchmark. So it makes sense for those pension funds to reallocate. So we think there's a deep bid for bonds that didn't exist 20, 30 years ago. We didn't have this explosion in retirement and the requirement to set aside funds.
So where are those buys coming from? The short end, the long end? How does that influence the benchmark 10?
Well, the great thing about those investors is they're going to want to be ultra long-term. So they're going to be buying 30-year because they have very long-term obligations. And so that's why we think the 30-year was capped. I mean, now it's a little bit obvious because the economy's slowing, but even at the beginning of the year, we thought the 30-year was capped around 4% because most pension funds are at 7%. So 4 is, a really good percentage relative to that. And it's, of course, risk-free if you're a dollar payer.
All right, Jay, one last question. Just quick answer if you can. What are you doing when it comes to portfolio protection? We mentioned all the risk, inflation, possible recession, et cetera.
What we do is we buy income securities, so large cap dividend stocks like we have in ICAP. It's also worth mentioning that MLPs are undervalued. There's a $19 billion merger, really acquisition by OneOak of Magellan. So we think a lot of the old economy assets are undervalued, particularly ones that have substantial yields like MLPs and pipelines.